In the Money is made possible by financial support from Old National Bank and Chicagoans like you. Thank you.
Hello, welcome to In the Money. I am your host, Kimberly Loftus, a CPA and financial executive who today is financially secure, but was not always. When I first graduated from college, I not only had a lot of credit card debt, but also very bad credit. I moved to Chicago and barely got an apartment and couldn't even get furniture because I didn't qualify for credit. I learned credit matters and impacts my future. Fast forward years later when I started my family and left the workforce with no job, I had banks begging me to take personal loans because my credit score was that good. What a difference learning how credit works and making it work for me made to my financial health and credit score. For anyone who has debt, you are not alone. Remember, we are in this journey together. There is more than $925 billion in personal credit card debt outstanding, with the average person owing over $5,000 just on credit cards. Wow. You can turn this around like I did by understanding how credit works and taking some steps to get out of debt today. The first step in controlling your debt is to make sure you know what that means. In the living room today, I have Danette Williams, who graduated from Roosevelt University with an undergraduate in accounting and an MBA. Danette has over 15 years in banking, as well as over 9 years as a financial auditor. Welcome to the show, Danette. Please explain how consumer credit works, as well as how it might impact your day job and someone's entrepreneurial goals through one's credit score.
Initially, whenever you're looking to apply for credit, whether it's a credit card, installment loan, mortgage, they're going to run your credit report. So the credit report is basically that. It's a report of any outstanding credit that you have, and it can go back to credit that has been closed for about 10 years. And it is one of the main factors that lenders look at before they will give you any credit.
Well, does it impact me in a way if I was looking for an apartment? Will my credit score maybe impact if I get an apartment or not?
Some landlords do run a credit report to see how credit worthy you are. So if they can determine that you're paying your car note on time, you're paying your credit cards on time, then the assumption is that you will pay your rent on time as well. So the credit report is also used to establish, like I said, your credit worthiness. Can we trust you? Are we going to get our money back?
Okay. Now, we've talked a lot about credit today. Can you define what exactly that means, credit?
So credit is when a lender not gives you money, but loans you money. And you sign a contract and you agree to pay them back.
So even when I do that little credit card application, when they send me in the mail and and that's a contract that I'm signing when I do that?
That is a contract, yes.
Wow, I did not know that.
You are agreeing to pay them back.
Okay. And then what about a credit score? What does that mean?
So a credit score basically gives a lender an idea of how you pay your bills back. So credit scores have a range. It could be as high as 850. It could be as low as 500. And usually the higher your credit score is, the lenders get an idea of maybe you pay back better than people that may have a lower score.
Okay. So it's basically looking at your payment history and saying this person, the higher the score, the more likely they're going to pay me back.
Usually that is the case.
The lower the score, the more likely they're not going to pay me back, based off of history. You might be a different person now, but all they have is your history.
That's correct.
And then, so if I define bad and good credit, bad credit would be a low score, and good or great credit would be a high score. And then you have those people in the middle.
Right.
Okay. If I was starting a business and I needed a business loan, it's business, it's not personal. So could my personal credit score impact my ability to start my business?
So I do believe that they do look at your personal in addition to other things with business loans. They're not quite the same, but yes, your personal credit always has an impact whenever you're looking to borrow any type of money from a lender.
Okay, so let's walk it back. So say I'm in college and I've never, I'm a freshman in college. I've never had a credit card, I don't have any debt, because I was just a kid. But then I start taking out credit cards. That ends up on my credit report?
Absolutely. So whenever you apply for any type of credit, once you sign your name on that application and you're approved, and once you start utilizing that credit card, it is going to show up on your credit reports. Now, whether you make your payments on time or whether you make them late, that is going to show up on your credit report as well. So yes, whenever you apply for anything, once you're approved and once you utilize that credit, it is going to show up on your credit report.
And so when someone applies for credit, so credit scores are, your history, your payment history is one component. What other things do they look at when we're trying to get credit?
So they look at your credit utilization. So if you already have existing credit, they look to see how much of that credit that you have used. If you're maxed out all of your credit cards that you have there, then that's kind of a red flag to lenders. Other things they look at is debt to income ratios, but yes, your score is the first thing that they see, and they have an idea of what your creditworthiness is. But they do also look through the individual, they're called trade lines, but your trade lines is just your individual credit cards, your installment loans. They look at those individually as well. So
for those who are not as well versed, can you define what you mean by debt to income ratio?
Sure. So the debt to income ratio is just the amount of debt versus the amount of income that you have coming in. So you don't want to overextend, or the lender is not going to lend to you if they think you're extending as far as your income. So the percentage for installment loans, I think the rule of thumb is about 35%. But yes, the lender needs to make sure that you have enough money. Even though you have this great credit score, we need to make sure that you have enough money to pay us back as well.
And that's also to protect the consumer, because you don't want them to take on debt that they can't afford.
Correct.
And then when you say installment loan, what do you mean by that?
So an installment loan, sure, I'm sorry. The installment loan is any loan that you take out where you're making equal payments. So a good example of an installment loan would be your auto loan. If you have a mortgage, your mortgage is an installment loan. Some people have unsecured loans. Any type of loans that you make equal payments, those are installment loans. You're making installment payments. Yes.
Okay, and then the other, like credit cards, vary because depends on how much you charged and what the minimum payment
That's
would
correct.
be. Okay, and then, so we talked about the credit score. We talked about the application process of what they're looking at besides just a credit score, how your usage of past credit, but also your income. What other things they might look at?
Well, they do look at the history as well. You have closed accounts on your credit report, so they will look at how those are paid. Of course, they look at the current credit, how those are being paid. They're going to look for delinquencies. They're going to look for collections. They're going to look for bankruptcies. So all of this information would show up on your credit report if you have any type of collections, delinquent payments. All of that shows up on your credit report. So
what about rent, people who rent? Because a lot of times you might not have a credit history, but you've been a good renter. Does that now, because I know there was talks about putting that on credit reports, has that happened?
So there is a product out there that does allow you to add rent payments, streaming services, and I believe utilities to your credit report. Traditionally, though, no, rent payments are not included on your credit report. However, if you left an apartment and you left a balance, that landlord could put a collection on your credit report. So your payments that you make every month won't reflect on there, But if you end up leaving and still owe the landlord money, that can end up on your credit report.
So what about the people who are, again, are good renters, and can't they go to their landlord and say, because they have a good relationship, can the landlord have the option to report it if someone asks them to report that to the credit bureau and you have a good payment history? Can that get reported that way? Or they have to, or is it some big process?
Now, I'm not 100% sure if any person can go and just report to the credit bureau. I've never seen it happen, but I don't think that just anyone can report to the credit bureau. Again, if you're delinquent, they can't report that.
Right.
But I'm not 100% sure about reporting rent payments on your credit report if you just ask your landlord to do that.
Okay, so it sounds like from how credit works, it's based off of your income and how much debt you already have, as well as your payment history, if you're a good payer or a bad payer, however we define that. And that's really how credit works. So based off of that information, whoever's going to lend you something is basing it off of that information.
That's correct. That's not all of the information, but the credit report plays a major piece whenever you're looking to borrow money.
Okay. Thank you so much, Danette. That was very helpful to all our viewers out there to learn how credit works.
Thank you.
Tune in this Friday at 7 p.m. as I discuss the journey of an adoptee.
In my records, it talks about the social worker's observations of me and my mother, and there was a disconnect.
Now joining us in the living room is Tamika Hill, who has her own personal success story of getting out of unhealthy debt. Tamika is a business owner, author, and licensed clinical social worker. Tamika, please share your own personal debt story.
Yes, I respected money and not credit. I was raised with abundance, I would like to say, not rich, but abundance. So I was taught early on how to have things but still respect money, because my grandmother would take her checkbook out and I had to help her balance it and write the bills old school through the check directory. And my 8th grade teacher, 7th and 8th grade, taught us how to do stock. Well, the problem was my family did not teach me credit. And so when I got credit cards, I was like, oh, I can owe them. They'll never be broke because I'll owe them forever. And I wouldn't pay the bill. And I would file bankruptcy because that was like a trend, or I guess you could say. But I would still have money. That was the craziest thing. My grandmother even said, why are you letting the cable get cut off and you have money in the bank?
Yeah.
Because I was a money hoarder. I didn't want to pay a bill because it was on credit in my mind because it wasn't visible to me. So I disrespected credit a lot. I ended up filing bankruptcy 2 times before I was like, okay, what's your problem? And with me also being a therapist, I said, okay, this has to be more deeper than this. And through therapy, self-discovery, I learned early, like, you never learned credit. Your first exposure was, in your 20s, but nobody taught you how to respect it. So you can't respect what you've never been exposed to.
Now, can you define what you classify as respect of money and the respect of credit?
It's kind of like what we use as disrespect, right? It's the opposite. So to respect something, you honor it, you don't abuse it, right? When you disrespect something, you abuse it, you have no care for it. So for me, respect of money was I always made sure I didn't overspend, I didn't underspend, and I saved. So in my mind, that was respecting the money. Well, the disrespect for credit was I get a credit card and I don't pay it back.
Right.
Or I would pay the minimum and still be charging and gaining interest on top of that. And so finally, I probably ended up one time with $40,000, $50,000 or something like that worth of debt at 20-some years old. I was like, oh well, I don't got to pay it. They got bankruptcy. So there are attitudes like that do exist, that I don't have to pay it because I can file bankruptcy, and you think, oh, you have a clean slate. But the truth is your credit score is going to drop to about a 430.
Oh, wow.
And you have to, And you're looking at the world now with 700 being good, not even excellent, but good.
Right.
So imagine trying to get your credit score from a 430 to a 700. That's a long journey. It doesn't happen overnight. A lot of people don't know credit takes years to build, and it takes one bad decision to blow.
So I'd like to talk about your mental health at this time. So you respected money, but you did not respect credit. How did it impact you the first time that you filed for bankruptcy and the second time? How did it differ?
I think because I was in my early 20s, it still didn't bother me, to be honest, because again, it was more like, oh, you don't have to pay it back, you just start over. The second time, when I started thinking, oh, I want to own a business, and I was like, okay, so what are you going to do different? And so with therapy, what it was I had to learn about myself was my money personality, which helped me to learn, like, you were never taught credit. So it wasn't because I was like mentally in a bad space, but it was my exposure and growing up with credit, or lack of credit, I should say, that kept me in the state of the hamster wheel of constantly disrespecting the credit. But at that second point, I was like, yeah, you're closer to like in your 30s now, you're close. So do you want to really keep doing this and you like nice things?
So putting your therapist hat on, what about those people who mentally are just distraught because they have so much debt? How is that different? Like, I see that's really different than your story. It was just more about not understanding how it works. But you do have those people out there who have just mentally, this debt really just overwhelms them.
Oh, yes, because we live in society that, teaches us money and credit is everything, which to some degree it does hold weight. But I would say you have to really sit down with yourself and figure out, why are you spending money? Like, that's the first route. Because you can get out of debt. There's all kind of bankruptcy, business coaches, financial institutions that's going to give you a platform. However, the key is, what's the root of the pattern? And a lot of times, like you said, people get so overwhelmed, but then we have to find stability in our mental health before we can even deal with debt, truthfully.
Okay. Now, going back to your story, realizing that you wanted to change, what are the steps that you took to now be rid of unhealthy debt?
One, therapy, to be honest, right? And I took a lot of financial classes to understand credit more, just for my own educational purpose. And understanding the root of why I didn't respect credit helped me to buffer when I got my first credit card, put it on auto pay. So even now to this day, all my bills are auto pay. So that way I never have to worry about paying a bill, so to speak. I'm a good money maker, but a terrible bill payer.
So what were in the classes that kind of clicked with you?
Say it again.
The financial classes that you took, what clicked with you to make you change or help you be better?
The biggest one, being honest, is money personality traits. That was one of the biggest ones. The second was learning how to build your credit.
Okay.
That was very interesting to me. And I think it was through a bank institution that, how they offer free classes, and I think a few other ones, just teaching you about how to buy a house but the ones that stuck to me the most was about credit cards and how to build your credit.
Okay. And now, talking about the personality traits around money, can you give a high-level recap of what that means?
So there's a psychology to everything. So even with our personality traits, we have a money personality trait, and usually the polar opposite, there are 7, but the polar opposites that most people fall in is compulsive spender or compulsive saver. And that has to do with you're constantly spending or you're constantly saving and not really experiencing life. And that usually comes from an upbringing or lack of in an upbringing. And we have to understand that in the now to unpack some of the things we do. And some things aren't going to change about you, but you have to learn the buffers when those barriers come.
What's interesting about your story is that you were a saver. You didn't like to spend money, but you like nice things and use credit for that. So how does somebody balance that out?
I had to learn this, even though it's a credit card, it's still money.
Right.
For me, I had to change my mindset about credit. I view credit as money now. Because I do have a respect for money. I still don't respect credit as much as I probably should, but I don't disrespect it either because I hold value to equate that, okay, this is still money.
So that is really powerful because you basically said credit is money, and then you had to change that definition and see dollar signs when you pull out a credit card. Because a lot of times people just pull out credit and then we know we have to pay it, but they're not looking at it as money. I think that's very powerful.
And I see double, to be honest. Like when I see it, and now because I'm older and wiser, I only pick credit cards that pay me, that benefit me. If I'm going to use it, then it has to benefit me because I'm credit worthy to pay it now. So it has to give me something back as well.
So like airline points, things like that, or cash back rebates. That's perfect. Well, thank you so much for coming on here and sharing your personal unhealthy debt story and how you got to healthy debt. Thank you so much.
Thank you.
Tune in this Friday at 7:30 p.m. on Channel 19 for a candid conversation with Michael Scott Jr.
What's funny is I had thought about running before. I thought that I was ready in 2009. Unfortunately, both of my parents passed in 2009.
Now, this is a time when I usually toss to a great video about money management from my good friend, Ben, and the folks at Old National Bank. But today, we're in for a very special treat because Ben Juergens, the Financial Empowerment Director of Old National Bank, is joining me right here in studio. Hi, Ben.
Hi, good to see you.
You too. I am so excited to share your money management tips today. And today we've been talking about credit scores. So earlier we mentioned 800, 300. What does that mean?
Yeah, so generally credit scores range between 300 and 850. We think of 850 being the best, 300 being the opposite end. So typically the way that it works is the higher credit score, everything in life essentially becomes cheaper when you need to borrow money.
Oh, I like that. So if I have a great credit score, then money is cheaper. So that means if I have a mortgage, my payment will be lower than someone, everything else being equal, has a not as good credit score.
Absolutely, because many people can still get financed depending on what their credit score is, but the higher we get, essentially it just becomes cheaper to borrow that money. So I think credit really becomes important so that in the event that we need to borrow, we can get things a little bit cheaper than everyone else.
So now I'd like to walk through those different types of people with different credit scores. So starting on the high end, I have that 800 almost perfect credit score. What can I expect from the market as far as finance?
So it's one thing that we always desire to get, right? That 850, or I think 800 to 850 is considered that excellent score. Good and bad things can happen. Good things means if I do need to borrow money for that mortgage or that automobile, I'm going to get the better interest rates. Lenders are going to come to me and say, we've got great opportunities. The bad part is sometimes we might be tempted to go borrow money that we may not necessarily need because we have such great credit. So we have to be careful, but it's a great opportunity if we need to borrow money to get it a little bit less expensive.
Now, what if I'm in the middle of the road, and what do you define as a middle of the road credit score?
Yeah, this day and age, people try to aim towards a 700 credit score where we can get above or better than normal interest rates. I would say typically in the banks, we see around that 650 to 720 score. And I always look at it and say, people always worry, if I'm one of those lower scores, what's going to happen to me? I think of a lot like school, right? If I have a really bad test grade in school, it doesn't mean that I can't get an A. It just means I have to work a little bit harder. And the same is true when it comes to credit.
Okay. And if I have, I hate to call it bad credit, how about challenging credit? What's that score look like?
Yeah, so challenging credit, I don't think I've ever seen the 300 scores. We've seen the 400 and 500s, even from sometimes very successful people, but they just really didn't put a focus on paying their bills. So when we see that, the ability to get credit is still there, but they're paying more for everything. Cell phones get more expensive, mortgages, automobiles. So we're accumulating the same goods and services, but a lot of times it's just costing us a lot more when we haven't taken the chance to really improve that credit.
And so for those who have the challenging scores, what are some of the things that they can do to get better?
Yeah, so I think when you look at these credit scores, right, many people might pull up a Credit Karma, for example, or banks look at FICO. So it's good to know what makes up that score or that grade as we look at it. And the biggest piece that we see from the FICO is your payments made on time, and the amounts that you owe. Those two together make up 65% of an overall FICO score. So I always tell people if they're new to credit or they've really struggled, the number one thing they want to work on is paying their bills on time, especially the ones that are financed, because that's what's going to improve the score or the grade, and then keeping our amounts that we owe a little bit lower. Those two combined will really boost the grade the most.
Thank you so much, Ben, for being here today and sharing those wonderful tips.
Thank you, Kimberly.
Tune in on Monday at 7:30 p.m. as I talk to Lauren Birchlove about respect and inclusion in the workplace.
You know, in some cases, folks don't want to be outed as trans or non-binary in the workplace. You may know that they are trans or non-binary because you have a close relationship with them,
Right.
but for, you know, whether it be safety, whether it be just privacy reasons, they don't want to share that information.
You have heard of multiple examples of freeing yourself from debt using different paths, bankruptcy and non-bankruptcy. Only you know the right path for yourself. For whatever you decide, you should not only look at the numbers, but also the mental impact debt has on you, and also realize you have to do the work. Bankruptcy and non-bankruptcy are forks in the road. They end the same, but the journeys are totally different. No matter what path you decide, you still have to do the work to maintain good credit and get an acceptable credit score. And yes, in today's society, credit is a necessity and should be used as a tool in your money arsenal. Credit only works if going forward you use it in a healthy way. If not, the unhealthy debt will quickly return. My money challenge to you is to take a good look at your inner self and understand why you use credit and assess if you can be trusted with it now that you know how credit works.